videos in the IPOs, equipment share, and ethos. If you didn't see the BitGo one, please watch on TikTok. It's about to come out, I made a long form of all 3 IPOs on TikTok, and I'm streaming BitGo live 7 a.m. Pacific time or 11 a.m. Eastern time. The 2 metrics I'll be using, EBITDA for equipment share because they are rental stock, and I'll be using PEG ratio along with PE ratio for ethos life insurance. Hopping straight into it, equipment share is the best backing. 20% in a $6.2 billion company is really, really, really good because the other 2 IPOs only have like 15 and 5% backing, and they're much smaller. 1.26 billion and 1.96. So equipment share has a ton of backing. Number 2, let's get into the EBITDA. We're using this because they're a rental company and they can write off depreciating assets like that as they depreciate and take in free cash flow. I'll explain it, but basically the amount of assets they own is worth more than the company they have. With their valuation when they're coming onto the stock market compared to the other ones in the stock market, which obviously their assets are worth less than the total company. Also, the equipment rental sector has done 138 to 226 over a 5-year period. That's amazing. On top of this, we have 20 to 22% year-over-year growth, which is really good when compared to the other 3 companies I'm compared in the rental space on the stock market already that have done the 200% 5 years are only gaining around 5 to 10% year-over-year. So 2x outperform. And straight, if we get into the EBITDA, equipment share has 11 EBITDA, which means it will take them 11 years of free cash flow to pay off the entire company, versus the average of 8 to 15 EBITDA. So they're around middle of the pack for that. But they make up with that with their asset value and also with their year-over-year growth. Next, we're using PEG ratio for ethos. Ethos is a life insurance, all-in-one life insurance. The sector by itself has done like 80 to 133% over 5 years. Pretty good, but not as good as the other one. Basically, the average of the S&P 500 for the last 5 years. At least it's not a bad sector. Basically, what's PEG going to do for this, we're going to compare this valuation compared to earnings and compare it to how much they're growing. Because Ethos P ratio is 22, but when you compare it to the other ones, the P ratios are much smaller than other companies. Notably 15, and then it's like 8 for pretty low P's. But the thing is, ETH's year-over-year growth is 50%. Yeah, the other insurance companies are like 5 to 15% year-over-year growth. Aflac being 5%. And when we take PE, which is 22, which is the higher end, and growth, we get a 0.44 EBITDA. 1 is considered fair value. So technically using this 1 ratio, it's half. The other companies trade at 1 to 4.